Howdy, everybody. Welcome to Liberty Call. Today is Friday, September 13th, 2024. Hope you're having a fantastical day out there in the interwebs. Beautiful sunny day here in Colorado. Wish you were here, but you're not. But before we get started, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell because you want to know when I go live. I might say something intelligent. Probably not today, but it could happen. All right, let's jump into today's numbers. Dow Jones was up 0.72%, 297 points. Markets were in a good mood. Closed at 41,393. S&P 500 was up 0.52%, 29 points. Closed at 5624. NASDAQ up 0.64%, 111 points. Closed at 17,681. VIX was down 2.99% today. It's at 1656. Canada up 0.4, Brazil up 0.7, and Mexico down 0.01. In Europe, Germany was up 0.92, the UK up 0.39, France up 0.41, Netherlands up 0.71, Spain up 1.23%, Italy up 0.34, Switzerland up 0.47, and Portugal up 0.68%. Whew, that's a lot of words. All right, Russian exchanges back in the green today. MOEX up 2.56%, RTSI up 2.75%. Let's see here in the Asian markets, the Nikkei was down 0.78%, Australia up 0.3%, New Zealand down 0.41%. In China, the Shanghai was down 0.48%, the Shenzhen Component down 0.88%. China A50 down 0.43, DJ Shanghai down 0.49, Hang Seng was up 0.75%, and the Taiwan weighted was up 2.96%. All right, so good stuff there. Let's get on over to the charts and see how things did for let's go to the 1 week. All righty, starting out with the Dow Jones. Let's find that little candlestick right there. All righty. Looks like the Dow's going to finish the week up about 2.59%. The S&P 500 looks like it was up just a hair under 4%. And the NASDAQ up again just a hair under 5.99%. Excuse me. Dow. Dow Transports up 1.96, and the Dow Utilities, where is that? Right there. Dow Utilities was up 2.45. So pretty stellar week all around. Looks like for the at least for the major indexes. So we'll see what the data looks like on Monday morning when all the reports come out. So excellent news there. Let's get that off the screen and let's hop into the economic data that came out this week. Start now with jobs. Initial jobless claims came in at 230,000. Forecast was 227. Previous number was 228, so a small tick up. Continuing claims came in at 1.85 million, right on forecast. Previous number was 1.845, so up by about 5,000 there. U.S. wholesale inventories month over month grew at 0.2%. The forecast was 0.3. Previous number was flat at 0. U.S. consumer credit grew at 25.45 billion. Forecast was 12.3 billion. Previous number was 5.23. So a big jump up in consumer credit. Little things popping up all over the screen here. So you can see a big jump there this month, and it's the highest since what was that? January of this year, or I'm sorry, January of 3? Yeah, 3. All right. Let's get on to the next one. Consumer Price Index year over year grew at 2.5%, right on forecast. Previous number was 2.9. Let's see here. Month over month, the CPI grew by 0.2%, right on forecast, same as last month. And the Producer Price Index grew at 1.7%. Forecast was 1.8. Previous number was 2.1. On a month-on-month, it also grew by 0.2. Forecast was 0.1. So that's where, was it the markets? What day did this come out on? The 12th? Yeah, yesterday. So markets were down in the morning when this came out. And then I guess, everyone got in a good mood by the afternoon and finished back in the green. But this was a bit of some worries that the producer prices were ticking back up. Consumer sentiment came in at 69.0. Forecast was 68.3. Previous number 67.9. So the last 2 or 3 months, we've been ticking back up. Certainly not as high as we were in the first part of the year, but we shall see. Export prices index month over month contracted at 0.7%. Forecast was a contraction of 0.1. Previous number was 0.5 growth. And import prices contracted at 0.3%, and the forecast was a contraction of 0.2. Previous number was 0.1% growth. All right, so that's all the data for this week. Pretty exciting stuff. I mean, nothing that really moves the needle too much on anything. Jobs are just kind of staying where they're at. But anyways, all right, let's get to the market recap. Wall Street advances as traders bets rise for bigger Fed rate cut. Yeah, they're just hoping for that 0.5%. All right, Wall Street main indexes rose on Friday as investors speculated on a larger interest rate cut from the Federal Reserve. Bets for a 50 basis point rate cut surged to 47% from 28, fueled by comments from former Fed President Bill Dudley, who argued for a stronger case for such a cut. This came after mixed messages on the likelihood of a larger cut following higher than expected producer prices and August consumer price data. Interest rate sensitive small cap stocks outperformed with the Russell 2000 small cap gaining 2.2%. Smaller companies, which rely more heavily on borrowed money and float rate loans, typically respond more dramatically to interest rate changes. Investors appear optimistic that a 50 basis point cut wouldn't signal a looming recession. Yeah. How do they know? As seen in the rally in riskier areas like small cap stocks. All 11 S&P 500 sectors rose, led by a 1.3% gain in materials stocks, boosted by rising precious metals. U.S. consumer sentiment also improved in September as inflation eased, though caution persisted ahead of the November presidential election. Adobe shares fell nearly 9% after issuing a weaker than expected fourth quarter earnings forecast. Boeing declined 3% as its U.S. West Coast workers went on strike, while Chinese e-commerce firm PDD Holdings dropped 3% after U.S. plans to curb low-value imports. And Uber gained 5.8% after announcing plans to expand autonomous ride-hailing services in Texas and Georgia. Overall, the day saw broad market strength, with advancing stocks significantly outnumbering decliners. So again, this has been a weird. Last week, everything was in the toilet. This week, everyone's in a good mood. It's just kind of weird. All right, next up, this comes from Zero Hedge. This isn't your grandfather's monetary and fiscal policy. This was written by Jane Johnson of the Mises Institute. All right, see what Jane had to say. In her article, Ms. Johnson explores the increasingly blurred lines between monetary policy managed by the Federal Reserve, the Fed, and fiscal policy controlled by the U.S. Treasury. Traditionally, these two entities have had distinct roles, with the Fed managing the money supply and interest rates and the Treasury overseeing taxes and federal spending. The 1951 Treasury-Federal Reserve Accord reinforced this separation, ensuring the Fed's independence from Treasury debt management. Yeah, well, we've seen how that's turned out over the last 70 years. However, Johnson argues that this separation has weakened, particularly with the advent of modern financial tools like quantitative easing and helicopter money. During the 2008 financial crisis and the COVID-19 pandemic, the Fed created new bank credit by purchasing Treasury bonds, essentially monetizing the debt and enabling massive government spending programs. This approach has led to questions about whether the Fed's actions are more aligned with fiscal policy than monetary policy. QE, which involves the Fed buying Treasury bonds and other financial assets, is described as monetary policy on steroids, injecting liquidity into the financial system. Helicopter money, on the other hand, refers to the Fed creating and distributing money directly to citizens without acquiring any assets in return. Both strategies have fueled debate over whether the Fed is overstepping its traditional role and the inflation that it creates. The article suggests that the lack of clear boundaries between the Fed and the Treasury, particularly in light of policies like QE and helicopter money, requires a re-examination of their roles. Johnson calls for increased congressional oversight to ensure proper accountability and clear limits between the two powerful institutions. Yeah, because Congress is going to do anything to rein in reckless spending. Yeah, if you believe that, there's a bridge in Arizona I'll sell you. Alrighty, last up, we have an article also from Zero Hedge, Recession Now or Stagflation Later, and this was written by Michael Pinto of pintoport.com. All right. Michael Pinto's article argues that the U.S. labor market is weakening, a necessary process to correct economic imbalances caused by years of easy money policies. The August ADP employment report revealed a weaker than expected job growth of 99,000 in the lowest in 3 years. Similarly, the ISM Services Index showed stagnant hiring, and job cuts in August surged 193% compared to the previous month, signaling a troubling trend. While job growth is slowing, the U.S. economy faces larger challenges. Pinto highlights the corporate earnings expectations are unrealistic, with the S&P 500 projected to grow 15% next year, despite slowing GDP growth and tightening lending standards. Rising interest rates, tax increases, and the expiration of the Trump tax cuts at the end of 2024 add to the economic pressures. Additionally, the yield curve's recent uninversion, a historic predictor of recessions, signals potential economic downturns in the near future. Pinto suggests that the Federal Reserve is not adequately addressing inflation despite its public stance. He criticizes the Fed for prioritizing asset price stability over inflation control, arguing that the central bank's focus on rescuing markets is exacerbating the economic divide between the rich and the middle class. Yeah, because basically they bail out Wall Street and big business and leave the little guy like you and me to pick up the tab for the inflation and the taxes. Finishing up, ultimately, Pinto advocates for a recession as a necessary short-term correction to bring inflation down and restore economic balance, warning that the current path may worsen income inequality and inflationary pressures. And lead us to, the 1970s and stagflation, which was an excellent monetary situation to be in for those 10 years if you were an adult and trying to make your way in the world. So, not that it was terrible for everyone. I remember my dad was, successful, but I mean, he worked in retail and was a good manager at Radio Shack. For those who actually remember that store, it was a pretty cool place to grow up in, the back room and playing with all the, high tech stuff at the time. But, today that stuff is, pretty, not very technologically advanced. So anyways, all right. Well, that's everything that I had for today and for the week. So if anyone needs anything from me, please go to DSAFinancialGroup.com. That's where you can go get all your financial needs taken care of, whether or not it's financial planning or for your retirement, for college. Not that I would recommend ever sending a kid off to a university because they're just going to turn them into blue-haired weirdos. But if you really feel like it, I will help you save up the money to do it. All right. Well, hope everyone has a fantastical weekend, and I'll talk to you all again next time. Adios.